Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a very special guest, Chris Martenson of PeakProsperity.com. Lots to talk about today. We got rising interest rates. The 10-year Treasury yield went over 3%, hit 3% essentially, but we haven't seen that in a couple of years. And a lot of people are concerned about rising interest rates, but the mainstream media seems to be okay with this narrative. They seem to think it's more of a positive thing for the economy, a sign of the strength that's in the economy. So we're going to get Chris's take on this. Chris, thanks for coming on CrushTheStreet.com.
Hey, you're welcome. I hope my signal's coming in okay. It's good to be here with you.
Absolutely. You're coming in loud and strong. Chris, you're an expert when it comes to the economy. Your website analyzes all of the problems that we're seeing with the unsustainability of all the debt and just kind of what's going on now. But there's a major dichotomy with what's going on in the underlying economy with earnings, at records in some cases here, 9 years into this bull market. So let's talk a little bit about this and just get your current thoughts.
Well, sure. You started this, Kenneth, with actually the most important thing. It's the interest rates, and it's not just the 10-year. Hey, that gets a lot of attention, of course, because things key off of that, like mortgage rates and whatnot. But look at the 1-year, 2-year, 5-year rates. Everybody's spiking at this point in time. LIBOR really spiking. So we're seeing a lot of rising interest rates at this point in time. And of course, for an economy, a world economy or a U.S. economy as indebted as ours happens to be, that's a really big deal. So, I mean, one quick number. We saw that LIBOR was up over a full percent, 100 basis points in the last year. And that keys over 350 trillion of assets. So what keys off of LIBOR? Well, it's going to be all your interbank overnight lending. It's going to be a lot of your rate, your Prime Plus, all these other products like that. So, quick number. What does a 1% rise mean to a $1 trillion of outstanding debt? It means $10 billion in new interest payments. So yeah, you look at these rising corporate profits. You look at the strength of consumer borrowing and whether they're taking out subprime auto loans or what have you. A lot of that is keyed off of how cheap interest rates used to be. I'm not saying they're expensive, but they're more expensive than they used to be. That's a really big deal. And of course, you're not going to get that in the media. They always miss what the big story is at the turn.
Now, we did see interest rates go to 3% in 2014 for a brief period of time, end of 2013 into January 2014. Is it possible that we go into some sort of taper tantrum and they start lowering interest rates, or do they keep going with this? The Fed seems to be hell-bent on continuing to raise rates here.
Yeah, it's hard to figure out what the Fed is up to. So this is why we're getting mixed signals. And this gets a little bit wonkish, but it's important, really critical. Prior to 2008, you could analyze a rate hiking campaign and you could understand it because the mechanism of how the interest rates were raised was really important. The Fed didn't have a magic dial. If they said, wow, we want the overnight rate or what's called the Fed funds rate, the quoted rate, to go up by 0.5% or 0.25%, what would they do? Well, they have to go out into the market and they have to remove cash from the banking system until the rate that the banks are charging each other overnight floats up by about 1/4 point or 1/2 point, whatever their target was. Since 2008, Congress slipped a little something into a bill that allows the Federal Reserve to do something called pay interest on excess reserves. So these are the excess reserves that they've shoved into the banking system. The banking system then round trips back into the Fed. The Fed now sets a dial and pays the rate of interest on that. Why is that important? Because the Fed is desperately trying to raise rates so that it has some ammunition when, not if, but when the next downturn comes. The thing that the people need to understand is they don't have ammunition because all they've done is dialed up the amount they pay on excess reserves. And so banks now have the choice of either lending to each other or to the Fed. And so guess what? They choose to lend to the Fed or each other at about the same rate. So the Fed has not withdrawn any liquidity from the market. They wanted to have their cake and eat it too. What they wanted was higher rates, but they didn't want to withdraw liquidity because everybody knows that if you take liquidity out of these inflated markets, bad things are going to happen. So this was the Fed being cautious, thinking we need higher rates, but we don't really want to cause any trouble, but we need some ammunition, but we don't want to withdraw any money from the market. So the punchline is this: if the Fed has to suddenly lower rates again, what difference would it make? And the answer is none, because there's already, what lowering rates does what? It gives you more money to lend. It makes easier financial conditions. They're still ridiculously easy by any standard. Look at Netflix raising a $1.5 billion like that on the cash burn that they've been going through. It's an astonishing proposition.
Chris, it's just such a dichotomy, right? You have the Federal Reserve trying to slow down the economy, the government trying to spur the economy with deregulation, slashing taxes, and it's just such a interesting dynamic. And you have to ask yourself why they're doing that. And we know that they're distorting the markets. Any insight on that? I mean, why this is just not good for an ideal economy to have a central bank controlling what the most important tool in the economy, which is money?
Well, it's a great question, Kenneth. And look, trying to figure out the schizophrenia between what the government's doing, what the Fed's doing, let's just dispense with that. The government does dumb stuff with money all the time, right? That's just what the government does. It always wants to spend more. It's trying to spend more to be stimulative during downtimes. It wants to spend more because times are good, right? That's just what the government does. So I don't think there's a lot of data in that. The Fed's interesting, though, because what they've done is, to really understand why I'm as spectacularly bearish as I am right now, you have to rewind to 1994. We had a little hiccup in the corporate bond market. Alan Greenspan freaked out, dumped a ton of money into the system, and that created the internet bubble. We had long-term capital management and that big hiccup in 1998. He fixed that, and then we broke in 2000. And what should have happened in 2000 was a massive wipeout, all the sins of the past, the creative destruction that should have all got wiped out, but it didn't. Ben Bernanke rides in and says, gosh, this is a little scary. Rams interest rates down to 1%. We get a housing bubble and other bubbles, right? But at least I can tell you this as an active investor. At the height of 2000, at the height of 2007, you could still find places where you could have a value play. If you were interested, you could find value in markets, either in emerging markets or in certain sectors. Anyway, fast forward a little further. Now we get to 0% rates under Yellen. And now we have the everything bubble where I can't find a single place to hide at this particular moment in history. You have to take extraordinary risk to get any return at all, or you have to just close your eyes, throw caution to the wind, and say, Elon Musk is able to walk on water, and we're pretty sure the more money Netflix burns, the more they'll make in the future, or whatever the pets.com stories are of today, right? You have to just believe that stuff. But the bottom line is the Fed oversteered in 94, way oversteered in 2000, really corrected the skid they were in 2007, and here we are, and I think there's a massive ditch coming because the one thing you can do, you can print money and create a party, but what you can't do is you can't print prosperity. You can't have a giant tequila-laced, rum party, punch bowl party, and get the kind of creative destruction you need. Right? The banking system probably should have got cut in half in 2008. Goodbye, Citibank. Hey, so long, Goldman. Right? These were banks that should have gone down, and they were rescued. GM, great company, but it should have gone, right? And another more vibrant company could have taken its place. All these rescues do is they just hide what should have, use that word carefully, should have gone into the toilet and swirled the bowl and disappeared, right? Because that's what happens. We do dumb stuff. The Fed thinks they are able to eliminate the business cycle. You just can't.
Yeah, it's an interesting thing, Chris, and I've done some thinking about this, and I'm curious to run it by you. The Fed really doesn't have competition out there. In the free market, in the business world, if Walmart makes a bad decision, another company comes and takes its spot. But they're operating in this vacuum of a monopoly, essentially, where we're all locked into the one financial system, and they've been artificially sustained because of it, and the U.S. to that degree. in many ways. So is this something that can continue to be managed, continuing to just stay at the top just because there's really no one else on the block to compete with them?
Well, Kenneth, it's a great question. I'm going to rewind even a little bit further. You mentioned a really important word in your intro, which is unsustainable. And truly, I think you can look at our rising debt levels, unsustainable. The liabilities that are unfunded at the pension level, state, municipal, federal, all the entitlement programs, obviously unsustainable, right? So, the only question we have to ask in that story is who's going to eat the losses? But at Peak Prosperity, we widen out two steps further, and we notice, this thing I created called the Crash Course starts with this thing of saying, hey, you need to understand how money works in our system, right? I don't care what the rules are of a system, whether you're in a supermax prison, in Illinois, or you're hanging out on a Fiji island. Every place you go, there's rules and there's a system, right? So knowing the system of money is really important. It's not hard. I've taught it to sixth graders, but you're talking to a guy who's got a PhD and an MBA from really nice schools. Nobody ever taught me how money's made. So let's look at money creation. And when you look at it, the way we currently operate a money system, of which the Federal Reserve is the guardian, that system of money has to constantly exponentially expand or it blows up. It's just a feature of the system. I know anybody listening to this, don't take my word for it necessarily. Go check out that portion of the Crash Course, and that's where so much is revealed, because once you say, wow, okay, so we have an exponential system of money. Money is just a claim on stuff. It's not wealth. What's wealth? Oh, it's real things made by real people that comes out of the real world. Then you wander over to that part of the story and you say, wait, can that grow exponentially forever? And the answer is, it can't. So when you want to talk about the ultimate unsustainability, we've got a money system that just constantly needs to make more and more claims, and we've got a world which can't deliver more and more as it used to. That's a regime change. The Federal Reserve is guarding what used to be. The new world is emerging, and that's where you start to see things like Bitcoin and other sort of expressions where people themselves are starting to say, I don't want to be tied to what is clearly an intellectually bankrupt, but possibly criminally insane way of running a system of money, which is a way we organize ourselves. It's agreements between people about how we're going to value not just our time today, but our saved efforts for the future. And when you have people running that in a way that you can prove mathematically is destined to fail, well, they don't deserve the faith that they've got. So, which is a great question, which is, if the Federal Reserve had competition, I guarantee you they would be swirling that same bowl at this point in time, because their broken ideas have no merit in the world we live in right now. It's an old idea, made a lot of sense in 1913. The world seemed infinite. That's not the world we live in anymore. They haven't caught on to that yet, right? So that's really, at a larger sense, the mission that I'm on, is to try and warn people about the idea that, hey, let me not say they're bad people or evil bankers or all that. It's that they're defending a system that's intellectually indefensible. And that's what's going down on our watch, and that's why the next 20 years are going to be really interesting.
Yeah, it's an interesting thing, and this political thing came to mind. The Federal Reserve is always trying to protect people from market cycles. That was the reason for why they were able to implement the Federal Reserve within the U.S. economy and control the money supply. And it reminded me of this gun debate, trying to control guns and distorting places, let's say, for gun-free zones, having gun-free zones. It's not that you're not going to have gun violence anymore. You're still going to have gun violence. You're still going to have market cycles, but now you've distorted the situation. And anyways, I don't know if I should have gone down a political little rabbit hole here, but it just reminds me constantly of trying to manipulate the free market, what is going to happen anyways, and then creating massive instability and massive inevitabilities, I should say, as well. So,
well, Kenneth, another way to say that for me is that when I said before I'm super mega bearish, the reason for that is simply because they have forestalled not one, two, but three full business cycles, and all of the errors of the ways that were prevented from sort of being corrected at that point. Those are all stored potential energy in the system, right? When you look at the amount of failed bets that have been made, then those all are going to come cascading down at once. It's like, well, we would have had kind of a little bit of a slide on that slope, but now we've got this major cornice overhang. This is going to be a ripper of an avalanche, right?
Yeah.
Simply because you can't offload the risk to outer space like they thought, and you can't, paper over bad business decisions forever and have it work out. Prime example, in Italy today, 20% of the loans in the banking system are non-performing loans. It's an entire insolvent banking system. What's Mario Draghi of the ECB been doing? Papering it over, pretending like, well, these will all just get better. No, if you lent your money to a junk-rated shoe manufacturer who couldn't compete with China and they fundamentally wasted all that money, baby, it's gone. That money capital's been betrayed. It's out the door, never to be seen again. So, the question is, to me, not does this get recognized, but when and how do I protect myself given that's going to happen someday?
Yeah, and it's such an interesting dynamic, and I'm going to continue to ponder it, where that stored potential energy is going to go, and is it likely to happen in the near future here? Because, again, there's not a lot of competition out there, and as long as there's not a lot of competition, when will people pull the plug? And that plug might not get pulled for a very long time if there's not anything to largely compete with it. But that does lead me to my next question that I want to ask you, which is gold. And it seems like gold is responding very well to rising interest rates. Even today, with yields hitting 3%, gold was up slightly. And, even in all things being equal, gold does not pay a dividend, which doesn't make a whole lot of sense in that yields are rising and people are putting their money into gold, which doesn't pay an interest rate while interest rates are rising. And it's just a dichotomy. And I'd love for you to extrapolate this for us a little bit.
Well, sure. So first, I'm not a person who thinks that gold responds well to inflation. A lot of people call it an inflation hedge. It's terrible inflation hedge. Look at gold hitting a high of $800, in 1980, and then it trundled down to 250 over the next 20 years, right? And what happened in that time? Did we have inflation? Oh, you bet we did, right? So that didn't happen in terms of that. But where we do find gold responding pretty well on a correlated basis is when the federal government is busy deficit spending by a large amount. So with the tax cuts plus the new spending hikes, classic, I don't know what people thought they were going to get with Trump, but hey, here's a guy who loves going into debt to get what he wants, right? So we see the United States going into a lot more debt, deficit spending. That's actually a pretty positive environment for gold. Second positive environment is when you have a negative real rate of interest. And so we've been in negative rates for a long time. I can't explain the last 4 years of gold price except for those 2:30 in the morning raids, which were astonishing to watch. And we now have data and evidence to suggest somebody was in monkeying with the price of gold. So take that for what it's worth. Now that I'm looking at rising rates, I think that, your decision you would have to make is 3% for 10 years. Is that a fair compensation? Would I take that? Would I rather have this lump of metal which pays no dividend or yield? So what are we actually parsing out here? Do I think 3% for 10 years is a fair rate to give to the government? I don't. If you get that up to 8% or 9% in today's environment, now I'm starting to waver a little in that. So we're still, in my personal world, 5 to 6% away from what would encourage me to switch from one to the other. Two, gold, if I own it outright, right, not GLD tracking trust, none of that stuff. I own physical gold, then I don't have any counterparty risk in this story. With even the most trusted sovereign debt out there, you still have counterparty risk in this story, right? And you have both the Treasury note itself, if you're holding U.S. Treasuries, and you have the Federal Reserve note, which is the thing under that you're going to exchange that for. Two layers, and maybe we could say the risk is small in that story, but not small if you're in Europe, right? There are people out there who are still holding Italian 10-year debt for less of a yield than U.S. 10-year Treasury debt. Crazy. I don't know what they're thinking. It's just absolutely nuts. But in this story, I would not even remotely be caught dead holding Italian debt at anything other than maybe 10% above U.S. Treasuries, given their financial condition, given where we are in the European story. So on that basis, we have to look at gold, as constructive in terms of Europe. But mostly you have to understand gold has been leaving the West and has been heading east for years. It's just been hemorrhaging. So from a fundamental standpoint, we look at it and we say, wow, thousands of tons have disappeared from the West, never to be seen again. They now belong to China. They belong to India. They belong to Russia. So when we look at that story on a fundamental basis, I just see gold as still having a pretty strong reason for being in my portfolio. And the number one reason is because gold does well during periods of financial systemic threat or instability. I happen to think the chance of having that come forward is pretty high as we look into the future.
Chris, talking about competition to the U.S., that's where I think a lot of the competition might arise from. I mean, we have China larger than the U.S. economy by certain metrics. GDP is expected to pass the U.S. by, mid-2020s, maybe as 2030. And China is accumulating gold and has gone into a tremendous amount of debt. They've done it through artificial measures by many, aspects. But the U.S. has gone into debt and spent that money all around the world on wars. But China has spent it on building bridges and buildings and infrastructure, arguably more productive, more efficient investments to build out their future. So any thoughts on that?
Well, sure, Kenneth. I've been to China a number of times, and every time I go, I get train envy, I call it. Right? Their infrastructure is amazing. They actually have legitimate 4G cell service. AT&T says I do here, but when you actually decode it, it's not. Their internet speeds are astonishing there, even in the most basic hotels in all the key metro areas. And so you're right, they've been investing in themselves. As a Chinese business person explained it to me, he said, Chris, the business of China is business. The business of the United States is war. They believe in a mercantilist policy. They believe in their magic checkbook, winning friends all over the world. They've been going everywhere, scouring for resources, buying oil deposits. They bought a copper deposit in Afghanistan. You can't get to it. The place is war-torn, and they outbid the next nearest competitor by $1 billion, right? So they get a story which says the world is no longer infinite. We have to figure out carefully where our resources are going to come from, and they're maneuvering themselves for that particular destination. As well, they have a lot of pride, and they should. They've got their technology in many cases is not this, what we like to tell ourselves in the United States is, oh, they just copy all our stuff and steal it. Not true. China has the only functioning quantum satellite in the world. It's orbiting the world with entangled photons, able to communicate, instantaneously. Amazing, what they've done there, and so on. China is also really taking the lead on the energy story, and if you, I'm sure you've covered it before. You want to look at the petro yuan, right? They have yuan-denominated oils futures trading now. China just passed 9 million barrels a day last month for imports. That puts them far and away the number one importer of oil in the world. That's going to continue for the next 10 years. And oil is the largest, most fungible, liquid traded contract in every sense of that word in the world. And China stepped up and said, we're going to be doing this, and we're going to be trading for this in our currency. And that's an enormous regime change. Again, the petrodollar being sort of chipped at, that's never been taken well by the United States in the past. China's too big to really do much except maybe threaten a little bit. But I don't think they're going to respond well to that. So yes, China's a big player. They're on the stage, and if you look at what they're doing in terms of resources, there's an amazing story about that gold just being one of probably 30 resources we could cover where China is in there accumulating, acquiring, and you might want to ask yourself, why are they doing that? What do they know? And here's the best part. When I was talking with the same individual, he's very high up in the Chinese leadership, and he said, I asked him about how you get to be a leader in the Chinese system, and he said, well, you're not really anybody till you've managed 100 million people for a couple years. Everybody in the Chinese leadership has a PhD or very highly trained in something. A lot of them doctors, a lot of them scientists, a lot of them PhD economists, whatnot. They have a lot of very highly trained people. He said, we don't have any lawyers at the top, though, which was really a dig because I think out of 535, Congress people, I think it's like 80% lawyers or something ridiculous, right? So lawyers think one way, Scientists kind of and highly trained, people sort of think another way, engineers and all that. And China's just crammed with a lot of scientific talent at the top, and they're really looking at things, I think, from less a political and more of a numerical example of where we are in this world story. And they're exceedingly well versed in history. They get it. They know what happens to paper currencies over time. They know what happens when you fail your people. They get it.
Yeah, that's an interesting thing. And you brought up oil, and obviously China is importing a lot of it right now. The economy there is doing very well. And silver, interestingly enough, has been very tied to the price of oil, seems like. For production-wise, maybe it's more of an industrial component, a sign that the industrial economy is revving up, or maybe it's something to do with China. But I'm curious to get your thoughts on silver and silver moving a little higher here with oil on the rise.
Well, if you check out a lot of the commodities, they actually move in what's eerie lockstep with oil. Corn, cotton, silver, and for good reason. The production of every one of these commodities requires a lot of oil input into their manufacture, processing, and distribution. So as the input costs go up, the output costs go up as well. So, this is just a story of oil correlating beautifully with gold, with silver, all these things. So that's part one of this story. Part two is that, and I've written about this extensively, most people that I talk to in the United States and Europe are really, unfortunately, unaware of this really key statistic, which is that oil discoveries for the past 4 years have been the most disappointing in the entire history of oil discoveries going back to the 20s. The 20s, right? This is like we barely knew how to poke holes in the ground back then. And so we've discovered a lot of oil in the world. The last 4 years, the most disappointing. Now, why is that important? Well, it's because in the oil industry, there's a big lag. It's about 5 to 7 years between finding it and producing it. So if these past 4 years have been really bad at finding it, it by default means there's going to be a lag 4 years, 5 years, 6 years out. We're going to have a trouble producing it. We're starting to see this emerge a little bit. I've seen 2 articles in the past month, one in Financial Times, where they've started to quote people who are looking at this. But if people listening don't understand that lag and that hole in that supply chain, then they're going to be kind of disappointed and surprised when, not if, but when the price of oil really shoots the moon again. So we'll go from the structural oversupply story to a structural undersupply story. We're going to go from a regime of 50, 60 to something higher. And that's without John Bolton deciding to lob, a few missiles into Iran in the Strait of Hormuz or anything like that getting sort of tangled up in the story. Just pure fundamentals. We should see a pretty high rise in the price of oil. My best bet is 2019 to 2020 it starts to show up. And then here's the key question. How does a world with $250 trillion of debt respond to oil that's $100 or more a barrel? And the answer to that is you see weakness from the outside in. You're going to see the weaker countries get clobbered first. That's what happened to Greece. Greece wasn't exposed to the U.S. housing bust in 2008. Why did Greece go down the tubes? Well, because oil hit $147 a barrel in 2008. What did that mean? Well, Greece imports 100% of their oil, so they're bleeding money importing oil so they can run their society. Plus, it makes travel a little more expensive, so they had fewer tourists coming in. And that means they had less revenue coming in at the same time. Double whammy for that particular country. That's what we're going to see at the country level, but you'll see those exurbs 90 miles out from LA where people are barely hanging on. They had to move that far away to be able to afford a house, and they have to drive to work, and you'll see those communities get just shellacked by oil that's at $5 or $6 a gallon in the U.S. again. So that story's coming as well, and there's nothing we can do about it. We had 4 years where we didn't pour about $1.5 trillion into oil exploration and investment. Didn't happen. And there's no way to accelerate that process, right? The oil business, it's expensive. It just takes time. It's kind of like saying, well, if a woman can have a baby in 9 months, couldn't 9 women have a baby in 1 month? The answer is no. Doesn't work that way, right? So that's in the rear view mirror. People need to know about that because that hole in oil supply discovery is something we're going to be having to wrestle with for a really long time.
Yeah, well put, Chris. That is very powerful there. I'd like to give you an opportunity here to share some more information. If people want to learn more about what you do, about peak prosperity, and again, thanks for coming on Crush the Street.
Oh, hey, Kenneth, my pleasure. Sure, peakprosperity.com is the website. I run that with the co-founder, Adam Taggart, and we've got three big pieces there. One is knowing. You and I have been discussing what we call knowing, right? Information is really important. We think that, having access to great data and not listening to the propaganda, the marketing, the opinion piece is essential. You got to get the data and make your own assessment of it. But knowing something without doing anything about it is barely interesting, right? So doing is really important. We really advise that people need to become resilient for this coming future. Financially resilient, sure, but also emotionally resilient, also physically resilient, also your social capital, really important. So we have a whole piece around that. And then the last piece is the being, which is this is a really extraordinary time to be alive. Both ways to look at that. Huge changes are coming. How people navigate that's going to be really important. And I really think that this is an opportunity for us all to bring our best selves out into the world. And so when you have knowing, doing, being, that's what we're about. And we spend all our time trying to encourage people that it's really, the future is going to be so different from the past. And you got to be ready for that every possible way.